everyone to Season 2, Episode 6 of The Behavioural Investor. Today we have Alistair from Adelaide. What's the time, Alistair?
6:10 in the evening.
It's 10:40 here in Doha. Ben, where are you? What's the time?
I'm in lovely Brisbane. It's 20:06 in the afternoon.
Okay. So we're living up to our reputation of behavioural investing around the world. Today, what we're doing is taking the podcast in a bit of a different direction, but it's still to do with behaviour. A couple of episodes ago, we interviewed Matt from Breaking the Market. Basically, we reached the peak there in one form of behavioural investing, which is a technique to minimize as much as possible the potential negative impact that behaviour can have on your returns by using a very sensible 3-asset approach in gold, bonds, and stocks to manage volatility, minimize it as much as possible, and never work as an active investor, so picking individual stocks. Where we got to in that episode is that using an equal weighted ETF for the S&P 500, you can get something like a return of around 8.6, 8.7%, which is incredibly good over the long term. In our infamous compounding sheet that we keep mentioning that Ben put together and talked about in episode 1, you'll get over 3 generations somewhere in the region of $3 billion. So, nothing to complain about. But what we'd like to investigate in this episode and future ones is a different way to look at behavioral investing, which is to confront head on the challenge really of managing your biases and other factors that can cause bad behavior with a view to fostering good behavior so that we can be successful active investors. That's why we've got Alistair on. I'm really building you up here, Alistair. Sorry for the pressure. A confession we managed to extract from Alistair before recording is that he's achieved somewhere north of 20% as a geometric return since inception through managing his behavior well. So, Alistair, would you like to tell us a bit about yourself, what your academic and professional background is?
As you mentioned, I live in Adelaide, been working since 2008 as an electrician and water treatment operator. I've become interested in investing and began studying Bachelor of Business Commerce a couple of years ago now, actually. So doing that part-time online, as well as working full-time and then analysing businesses as well. Purchased my first share under my own name in 2009, pretty much almost without intending to, timed the bottom of the market, which was pretty lucky. So I've really only been investing in a pretty long bull market, which has given me a boost in confidence in my abilities.
Just a question on that. What was the share, if you don't mind sharing?
Sure. So the first share I bought was Leighton Holdings, but CIMIC Group, now it's known as.
How have they gone over the last 12 years?
So I've had 2 portfolios. Portfolio 1 is from when I first started investing. And then over that time, I've started to educate myself and things. And then that's when I created Portfolio 2. And that portfolio influenced my investment philosophy and things. Whereas the first portfolio was just me buying shares with Dad helping me out, things like that over time. So there's no real reason as to why I've bought them. And in the meantime, though, in the last few years, I've pretty much sold down all of my original purchases except for Cochlear and CSL, which have proven to be pretty good performers. I have worked out on one of my spreadsheets the performance of each of my purchases in comparison to my benchmark, which is the ASX 200. If you don't benchmark and hold yourself accountable, you could be spending all this time and money on investing in, whereas you should probably just be focusing on something else.
You can benchmark against the market. Do you also have any intellectual or investing heroes that might have inspired you to get into this, but you also compare yourself against?
I don't really compare myself against anyone else. I learn from people. Obviously, Warren Buffett, favourite of yours, Will. And
I knew he was your hero, Alistair.
I think if you compare yourself to the performance of other people, you can become competitive and then influence your decisions.
Who are some of those, other than Buffett and some of those big names that people know of? Are there any names that you could mention that you've learned from?
Before I got introduced to Buffett, I think Roger Montgomery's book, Valuable, all the material which I read is all along the same lines of quality businesses at fair values, really. Read his book, which was a good introduction. Peter Lynch was a good one. He's an American, pretty well known.
A couple of local investing heroes that spring to my mind are Matt Joss, although he's New Zealander, but we'll claim him, and Sage Simeon on Twitter, Andrew Page.
Yep.
Started Straw Man. What do you think of him?
I've read all his articles and things, and they're very insightful. He's done extremely well for himself. Anyone really, if it doesn't matter who they are, you learn from them or gather some sort of information which you can implement into your own strategy, as long as you understand it and it resonates with you and your beliefs. I don't think it really matters who. It doesn't even have to be from investing. It can be from external.
We have that approach too with some of the people that we've interviewed. And I like your emphasis less on hero worship than on simply extracting lessons from them. So yeah, that's great to hear. One thing that you did in preparing for this interview was you sent us owner manual or user manual for your fund. I'm interested if you could tell us a little bit about that as a kind of elevator pitch.
It's called a fund, but it's my own family's portfolio. Treat it as though it is a fund, because that's my eventual goal, is to run my own fund. So at the moment, each quarter I provide an update to whoever wants to receive it of how the fund has performed.
What's the purpose of writing that manual? What are three main points from it?
So the owner's manual is taken straight out of Warren Buffett's book. So it's what he's provided to his shareholders is what it is. It's an owner's manual. It's what it sounds like. What myself as a potential fund manager, if you were to invest with me, is what I'd be looking for and what you can expect from me. So type of investments, what we'd be looking at. So returns on capital, profit margins with little, no debt, and also long-term growth prospects within the industry. Say, for example, like my biggest holding is Nick Scarley, which sells furniture. I mean, the styles and things might change, but we'll always need furniture. The way we might receive it or manufacture it or buy it online or whatever, obviously is going to change, but the raw fact that we're going to have to continue to need furniture into the future isn't going to change. So that's something I like to take into consideration. It explains what type of person I'd look for who would potentially invest is someone with a long-term mindset who understands that the best time to be investing your money is at the bottom of a crash. So when everyone else is fearful, that's when you should be putting your money in.
You've described the behavior of an investor there.
Yeah, it is like that, describing the behavior, the attitude that I want, because you don't want people, because especially if it's a fund structure where it's open-ended, people can take their money in and out. So you run the risk of, if the market's tanking, that people get scared and pull their money out, and then you're forced to sell, at below intrinsic values. And if you keep doing that on a consistent basis, you're bound to lose money. I also emphasize in there that people should only be investing excess money. They should have an emergency fund, because you don't want to be forced to sell your investment just to cover these expenses, because chances are more than likely that the time when you're going to need that money is when the economy is down, so the market will be down, and it's probably the worst time to be selling. And I also mentioned I've got a large proportion of our family's wealth invested in portfolio, so that provides a massive incentive for me to make sure that the fund does well, because I've got, as they say, skin in the game. And also I follow Tony Hansen, who's a zero fee fund manager. So he only charges a performance fee. So unless the fund outperforms the benchmark, the fund manager doesn't get paid. So that's something which I would most definitely implement.
That was a long elevator ride, but I'm sold.
It's not an elevator pitch because no one can buy in. So
Well, Alistair, tell us about your approach to investing. What processes do you go through, and can you also describe how that benefits you from a behavioural perspective?
So I've got a spreadsheet that I go through, which just keeps getting bigger and bigger every time I analyse companies. You go through by first collecting and collating the data from the financial statements and also the notes and putting them into the spreadsheet, and then it creates a restated financial statement to help keep things consistent as accounting rules have changed and things like that. The big time consumer is working through my checklist. So I think there's about 106 checklist items that I go through, all covering different areas. So for example, I've got a checklist on the business itself, making sure that I understand how the business works. I think I'm sort of going a bit off track here. I'm not going back to that question, am I?
No, I think it is of quite good detail. For example, with the checklist, you've got 160 items that you say. From a practical perspective, how do you go through each of those items? It must be quite tough if you've got 160, give them any strong depth of thought and consideration, or is it something that it does force you to, you've got the mental strength and the behavioural strength to actually go through them and consider them in proper detail.
So with a checklist, with each item, there's a spot for comments and then a spot for a rating and then a spot to flag an issue. So I read the question or the checklist item, and then I've got to write a sentence, or it can be a paragraph or 2 paragraphs, depending on the question and how much relevance that it is in answering that checklist item. And then from there, I can give it a rating out of 5. So 5 being good and 1 or 0 being terrible. And then if it's poor rating, I can flag that checklist item as a potential risk that could occur. So by going through and actually writing down an answer to each of my checklist items makes me think and go through the question itself and make sure that I fully sort of understand what I'm asking myself.
When you go through that checklist, do they act as hurdles in the sense of if a company fails one of the checks, you don't go ahead any further in the checklist, or do you just completely?
Yeah, I don't really have there's no one individual thing where if it fails that, then I cancel it out. Like when I do my filters, a broad market filter, I keep them pretty broad because I know that businesses, they're not consistent performers. They go up and down with the local economy and global economy and things. So you're going to have times where the return on capital is going to be low because for whatever reason, and that particular time might be a good time to buy a good quality business. So I don't place too much emphasis on each individual item, but as a general rule, I would like on a consistent basis, returns of capital, maybe above 10 or 15%, and low debt or some sort of cash position or something like that as a general rule.
On that issue of 160 checklist items, that has behavioral control written all over it, because I reckon so many active investors who are treating the stock market like a casino and lobbing 10 grand on something they've spent 2 minutes understanding just the name of, and have heard something on, I don't know, Channel 7, the 30 seconds they spend on finance in the news. That's one side of active investing. And then there's Alistair with 160 checklist items. This is the definition of doing everything you can to have a considered approach.
Yeah, well every time I read a book, if it's worth my time, I'll study that book. So most of these checklist items are from books. A lot of them are on the financial side of things is from a book called Financial Shenanigans, which is just going through decades of businesses which have basically just pulled financial shenanigans or tried to fool investors, and just what to look for in the financial statements to try and avoid making poor investments. And then other things sort of like growth side and stuff, you got Peter Lynch and reading some of his books and on what to look for, and then also sort of some market research. Credit Suisse had a Measuring the Moat article, which had some really good things to look for in a company on how to analyze its moat rating or its ability to capture consumers' minds.
Okay, so it sounds like as the ultimate behavioral investor, you have a funnel of books as well that you're constantly analyzing and learning from and reading to derive more checklist items or to extend your framework, basically. So you're you're using these books for more things to look for.
So it just keeps evolving over time. I hope to keep up with whatever's relevant and to be sure that I cover as many bases as I can. So, I mean, there might be some things which have doubled up in there because I've probably got to go through it. But yeah, overall, it's looks at some key areas in the financials, in the management, competitor environment. And I also look at the ethical characteristics of the business as well to make sure that it meets my sort of ethical criteria.
Okay, so the price you have to pay then to earn your 25% geometric return, and over 3 generations, by the way, the the outcome of that is just, I don't even know what that number is over 3 generations. Yeah. Like I can't even, it's got 1, 2, 3, 4 commas. So we're into the trillions. All right, so to get this sort of an outcome, it's not a joke. It sounds like you're constantly reading books from the best investors. You read those books seriously, constantly extending your list of what is now 160 checklist items. You are systematically going through every potential investment with those items that have been distilled from the best investors who have written these things down in these books. Sorry, Ben, you want to say something?
Just with that point you made around 25% growth and the effect over 3 generations. Can you invert it? So at what year do you get to $1 billion in the spread?
What year? So if you're chucking 35 grand in because you're an expat working in the Gulf in a tax-free country, you said $1 billion, Ben?
Yeah, what year do you get to $1 billion by investing 35,000 each year and compounding that?
A billion. Where are we? So after
50 or 60 years or something.
After I've got it here, the 46th year, $1,450,739.
Because if you look at Buffett, for example, he's compounded his net worth at an average rate of about 25% a year. I think I've sort of,
especially initially, I think overall it's actually more like 18%, because the more money you accumulate, the harder it is to buy the smaller stocks that are going to move the needle.
Yeah, well, this is starting from when he was, I think he had like 100 grand when he was 20 or something, 21, which was quite a bit of money back then. But yeah, so that's his wealth over time. But it's not something I think you needed a lot of probably good fortune as well to do that over a long period of time, I guess. But
okay, so overall the point so far is that it's serious work, it's hard work, you have to be studious, you have to develop your own framework, it has to be supported by a spreadsheet, you're going to be constantly reading books, and you're going to be exploiting those books by extending you're viewing them only as a means to extend your framework and refine it, to remove things from it, to add things to it. I'm trying to keep up with you here, Alistair.
And as a bonus, I enjoy reading them, so that always helps. I think that's a big thing as well. You've got to be passionate about it, because it takes up a lot of time and energy to go through it. So if it's not something that you enjoy, perhaps you're better off looking at the passive investments or investing with a fund manager and then spending your time doing something which you enjoy, because you'll probably get a lot more benefit out of doing that.
Okay, well, that takes us to the next question. So what are the limitations of your system that investors need to be conscious of if they want to use it, for example, around fees and taxes and other limitations like you were starting to talk about?
I'm not sure what you mean by fees and taxes, I guess, but
how do you minimize them, for example, because those are two of the ways that most investors fail.
Yeah, well, that's quite simple, that really, I guess, is you just buy and hold and then that way you don't have to pay any taxes. I think I've just read A Tale of Charlie Munger, so it's just a book about his quotes, giving a brief explanation about them, and in one of them he sort of mentions how by buying and holding, that can add an additional 1 to 3%, this is his calculations, on your annual returns, which is just purely from not having to pay that annual capital gains tax on your investment. So if you just let it run over time, yeah, it's quite beneficial. And especially in Australia with our franking credits, we can utilize the dividends a lot more. So that provides some sort of income if we need it and doesn't force us to have to sell our shares. But
okay, so you're talking that's a limitation that your approach doesn't have, because you are a buyer and a holder. So yep. What are some actual limitations with your approach that if I was to go to growthwithvalue.com and faithfully follow your method and spreadsheet, what are some potential pitfalls?
My spreadsheet's probably like going inside my mind. So it's for you to understand it, it probably won't make not too much sense to some people, because I haven't really explained it very well. But I guess the limitations for the active investor is you've got to be just that. You've got to be active and stay on top of your game. So, and read financial reports. I mean, you don't need to be, I mean, when I say active, I don't mean like every day, watching the market. I mean, once a year when the annual report comes out, or every 6 months when the half yearly report comes out, you should pay attention to what the business is doing and be sure that it's staying true to the reason why you bought it. That's another reason why it's good to go through a checklist and write down these things. You know why you've bought the company or the business. So then if it changes fundamentally, that's probably the best and only reason to sell it. But yeah, limitations, just time consuming, I guess.
So how long would it take to go through your value investing analysis sheet for Nick Scully, for example, or Flight Centre?
Well, for me, it takes a long time because I'm also working full-time and studying part-time and have a young family to contend with as well. So, but just if I was to able to do investing full-time, it'd probably be a full-time job. It'd be a few weeks worth of constant study, analysis, and writing it up, because I like to write up and I actually share them as well, and an analysis of the business, which helps ensure that I understand my investment. It's quite a time-consuming thing.
To try and illustrate things as starkly as possible, you get into the trillions in 3 generations by spending weeks on your analysis rather than only billions by just being a passive investor and managing volatility between gold, stocks and bonds.
Well, I guess once you've made your first trillion, you probably don't need to keep
then you go into passive investing.
Yeah.
Become a property investor. Buy land.
Yeah, I mean that is the truth of it. Is not an easy feat. You've got to put the time and effort in and enjoy it. Really, I think the big thing is to enjoy it and be inquisitive.
Sure, I got one more on this topic before I hand over to you, Ben. Another potential pitfall then, Alistair, and this is something that Ben and I have been sort of conscious of when we've been, since the start, trying to apply Kenneth Marshall's framework, is that you could spend 2 weeks and then find out that it's not worth it.
Yep, exactly. Yeah, so
minimize the occurrence of that wasted time.
Yeah, that's the big thing. Is you try and hopefully can filter them out at an initial stage using a sort of a stock screener. So that gets rid of a lot of companies, and then I've got an ethical screen to get rid of, which also eradicates a lot of companies, and then I sort of have a pretty lenient debt screen, and that gets rid of a lot of companies. But by the time you just look for sort of profitability, you find that you've removed 80% of the market, or the Australian stock market. Really, it doesn't really take that much of a filtration process just to remove the majority of the market. But yeah, once you put in that time, it is hard to let go. And then
yes, there's a bias there too. Yeah, that you have a confirmation bias.
Yep. And also another problem with the active investor is you're going to be going against market trends. So you've got to be ready to, like in March, when everyone was thinking the world's going to end, you've got to see through that and think, okay, these businesses are hopefully going to come through out the other side. The world isn't going to end. That's the time you should be investing your money.
So the limitation there is that you have to be courageous. The approach could cause anxiety, and you as an investor may not have the wherewithal to deal with that anxiety. So you may have the best investing approach and framework and tool from you and your website, but you don't have the courage to actually expose your money to the market under those.
Yeah. So for example, when I first bought Flight Centre in March, when the market was tanking, I think I bought them about $19 or $20, but they went on to fall. I think their low was about eight in the $8. So you've just lost half of my investment or more in a matter of weeks. But because I had those weeks of analysis and study behind me, it's given me the conviction and the confidence of understanding the business, seeing and believing that it can get through lockdowns over the next 2-3 years or however long it could end up being, and then having that conviction to be able to keep investing and buying more. So
so maybe to distill things, your conscientious and serious approach where you spend 2 weeks getting acquainted with a business before you expose your money to it, the aim of that is so that you have the conviction during a 50% drawdown to get into it.
Yeah, exactly. Yeah.
That's the standard you're working to.
Yeah, that's the thing as well. Like I share my analysis, but someone might read it and then buy, but they haven't done that research themselves. So they don't have that conviction behind themselves unless they trust everything I say. That's a big benefit from putting in that time. So it's also not be a benefit by a deterrent, because you might want to buy a company because you spent all this time invested into it, but it's also a major benefit from giving you that conviction.
So one of the aspects with the spreadsheet that you've developed is that you do a discounted cash flow analysis. Just for people that aren't familiar with that, can you explain what it is and why you use it instead of multiples combined with thresholds?
The reason why I use the discounted cash flow rather than multiples and things is purely because I don't really understand multiples. They don't really make sense to me in a business sense. If I'm going to buy a business, I'm going to look at its cash generation, how much money it makes, and then how much of that money can I, as the owner of the business, take out and pay myself with. So to me, that's what you should calculate the value of a business on. So a discounted cash flow is just, it's a big guess, really. You've got to calculate a growth rate and then a cash flow as well for the company. And then you grow that cash flow at your calculated growth rate. And then the sum of those cash flows is basically how much money you can take out of the business. So it's commonly called free cash flow. But then you've also got to discount all those future cash flows to a present value, because a dollar next year is not worth the same as a dollar today due to opportunity costs and inflation. And instead of buying this particular investment, I can put my money elsewhere and earn an interest on that. So you've got to discount all those future cash flows. And to me, the discount rate is basically the percentage you want to receive from your investment. So theoretically, if you have a discount rate of 10% and it gives you a calculated intrinsic value of $10 and you buy the business at $10 and everything you've analysed for the business, the growth rate and everything plays out by the book exactly as you intended, theoretically your annual return should be that equal to that discount rate. So I guess that's a good thing to sort of understand with a discounted cash flow. It gives you sort of that.
Honestly, I always get a bit thrown by the word discount. Can you explain what that means again?
It's just bringing a future cash flow or a future dollar into a present value, discounting a future cash
already.
So, well, because if I was to give you an option, so if you think of when your parents bought a house, the cost of that house would have been a lot less than it is to buy today, that same house today, and that's because the value of that dollar is depreciating due to inflation. And then also you've got to consider that this money you're using to buy the business, you don't have to buy that business. You could put it into bonds or into another company, which earns a completely different return. Yeah. So if you've got a safe return of 5%, you would want to make, and you're going to be buying a risky business, you want to make sure that you're going to receive at least that 5% return. A discount rate is basically taking into account the purchasing power of a dollar and how it depreciates over time. So you don't want to buy, if you don't discount your investment, the cash flows, you're going to be paying way too much for that investment. So over time, you're going to be expecting. So today, I can, for $100, I can buy a lot of groceries and whatever. I don't know what you can buy for $100. Can you
buy lots of fuel?
Buy lots of so you can get a tank of fuel or something for 2 tanks of fuel for $100, depending on your car. If there's no inflation or no whatever, if in 20 years' time that company I've bought pays me another $100, I can buy another $100 worth of fuel, which is another 2 tanks of fuel. But in the real world, 20 years' time, for $100, I might only be able to buy a quarter of the tank of fuel. So I don't want to pay for $100, that future $100. I don't want to pay today to receive that $100. I want to pay the equivalent amount to receive a $25 in today's terms, if that makes sense. So I don't want to pay a full, the full $100 today. I only want to pay the $25 today. Well,
right. So another way is it's not discounting. Well, you're discounting if you're considering it in terms of the amount of money you're going to receive in the future. The other way is that you are boosting up the amount that you're paying now to put it in terms of what money will be worth in the future. That's another way to do it.
Mm-hmm. Yeah, but a simple way is to think of it is just it's your minimum required return of what you want. So if from this investment you want to earn 20% a year, then you should discount all those future cash flows by 20%, and then all else being equal and your analysis turns out correct, then you'll receive a 20% return on your investment.
Okay, if it actually reaches that value.
If the company grows and increases the cash flow at what you've calculated and priced in, then theoretically that's what you should receive. But,
so this is bringing up the subject of time. It seems like time, the same with Ben's sheet, it involves a huge amount of time, 3 generations. But a large factor in your decision-making, Alistair, seems to be that you are spreading the potential income of a business over a certain period of time and making. So all I'm saying is you need to have time as a factor in your decision making.
Mm-hmm.
Great. Do you want to cover the question, Will?
I don't know. I guess I always get so confused with this discount cash. Like I actually, as you saw, I modified my own sheet to automatically do DCFs after reading your book. Alistair. So I get it, but it's just not intuitive to me. That's what I'm trying to get at.
The way I think about it is there's sort of two ways, and it's pretty much what Alistair just explained. One way is if someone offered to sell you today $10, how much would you pay for it? So today you'd pay up to $10.
$10.
Yeah, up to. So you might pay $9, you pay up to $10. But if someone was to offer to sell you $10 in 10 years from now, how much would you be willing to pay for it? You probably wouldn't pay $10 because when you got the $10 in 10 years from now, you'd only be able to buy maybe a loaf of bread rather than a loaf of bread and some milk in today's dollars terms. So you would actually discount that back, that future $10, and you'd only pay, let's say, $6 today for it. It's that basic concept. It's not just about inflation. It's also
so everything in the future looks like it's worth more now. Everything in the future
everything in the future is worth
will cost more.
Will have less purchasing power. So that's one concept of it, and that's what Alistair was explaining. The other concept is if you've got $10 to invest, what could you invest it in? And Alistair gave the example, you could put it into bonds and maybe, I don't know what the bond rate is, let's say it's 5%. You could get,
I thought it was negative.
Whatever it is. Just as an example, you could get 5% returned every year over the next 10 years. So that almost acts as an opportunity cost there for the minimum amount.
Yeah.
Be prepared.
So you need at least the same return or more. There's the equity risk premium, right?
That's the equity risk premium is the difference between the risk-free rate of return and
bonds.
So, well, the government bond, which is, and then the equity risk premium is the additional risk that you want to put on top for taking on an investment in an equity in shares.
Yeah, I think I'm starting to get an intuitive grasp in that. Obviously, $10 in my wallet in 2040 is going to be worth less than $10 now. So if I'm anticipating getting $10 from a business in 2040, I will pay less. And this is where I again lose my intuitive grasp, because I guess this is the concept that when you're investing, you're buying a stream of income.
Mm-hmm. So if you're going to receive $10 in 10 years' time, so you've got two options with that $10. You can spend it today and buy $10 worth of goods. So if you do that, then that means you want to pay the equivalent amount. So in 10 years' time, you might find that it's worth about $3 today, would buy you the equivalent amount in 10 years' time. So otherwise, you can invest that money.
The job of an investor is to purchase cash flows, but you want to purchase it after you've adjusted it, because you're buying it you're anticipating the cash flow in the future. So because it will occur in the future, you need to adjust it for inflation. So you need to discount it. The adjustment is called discounting. And so all the job of an investor is to purchase that free cash flow in the future at a rate that's been adjusted so that you're not overpaying for it, thinking as though you were purchasing it now. And you want to buy it when expressed as a share price, it's cheaper than that cash flow in the future is actually worth. Is that the job of an investor?
I guess so. Maybe it's part of it.
Because basically what the stock market is a bunch of free cash flow generating vehicles. Yep. Every business, ultimately, whether it's selling tires or ice creams, after the cost of doing business and paying your employees, etc., you get cash flow, which is the owner earnings, right? Free cash flow. Mm-hmm. So I don't know, I'm trying to keep up, but I don't think I am.
So when you make an investment, you're buying future free cash flows, basically. So you're paying so much to receive so much into the future. And the further into the future it is, the less those dollars are worth today. So you don't want to pay as much for them. So if you don't discount it, you're going to be overpaying for that business, because you'll pay a lot more to receive $100 next year than you would pay to receive that $100 in 30 years' time. So you'd pay $90 to receive that $100 in a year, but in 30 years' time, you might only pay $10 because that $100 in 30 years' time is going to be worth a lot less. Its purchasing power is going to be a lot less than it is today.
Okay, and the opportunity to make money, not to just pay what that $30 in the future will be worth now, but to pay less for it than it's worth now.
Well, that's the opportunity.
Yeah.
The idea is whatever you want to earn, that's what you should discount your cash flows by.
Okay, and there's the idea of the margin of safety. Well, the margin of safety is
the margin of safety is
for mistakes.
So after you've made your analysis, you can apply a margin of safety. So I have a minimum 20%. So if I calculated it $10, I'll take 20% off, and my purchase price will be at $8. And that $2 difference is to account for me making mistakes.
Yeah.
In my analysis. So a recent example is I own shares in Vita Group. They operate about over 100 Telstra licensed shops, and they have a rolling 5-year contract. Just in February, it was announced that Telstra is going to take back all these licensed and franchised shops back in-house and then have them owned or operated by Telstra. So that's in 5 years' time, 97% of income for Vita Group is going to be non-existent. At the moment, they've got 3% of revenue generated from aesthetic skin and laser treatments clinics, which is their new sort of area they're going to be growing into. But because I had a margin of safety and bought them at such a discount, the price I've paid is probably, even though this recent announcement, even though after the next 5 years of cash flow, it's pretty much is equal to the price which I've paid, and that's because luckily I had a margin of safety implemented. But
that one, because obviously that company's gone through a fundamental change in its future. What have you decided in that share, in that stock? Are you holding on to them, or are you decided, because the future is so fundamentally different, you've decided to sell?
I'm going through that process at the moment. It's a downfall on my behalf. I should have been probably better across the skin health and wellness, I think that's what they call it, segment of the business, as that was the more long-term future reliable growth opportunity. But I think so I'm still invested, and I think I probably will stay invested because the manager, Maxine Horn, the founder, she's the founder and CEO of the company. So she created the Phone Zone businesses. I don't know if you've heard of them, which all got basically rebranded into Telstra shops. Yeah, so, and she's got a large stake in the business as well. So I think that they would probably, and it's a very fragmented market, the skin health and wellness clinics. So there's plenty of room to increase their market share. So I think it's probably not going to be a terrible investment, and the price I paid for it, still taking into this news, instead of at a discount, which I thought I had bought at, is probably, because I bought it 2 or 3 years ago, it's now sort of at a fair value.
I'm going to have another crack at this just to try and finish off the discount cash flow topic. So basically, if you're anticipating, for example, over the next 10 years, a business is going to return $30, you have
a year, or
because you're looking at it over a period of 10 years, right?
Myself personally,
yeah,
I look at it depends on the company. But,
okay, and so for example, if it was the next decade,
yep,
are you basically looking at the owner earnings, so the free cash flow, and you're summing those anticipated owner earnings over the next decade?
Mm-hmm.
You're getting the sum of that, and because of inflation, we have to adjust that final cumulative owner earnings, anticipated owner earnings over the next decade. We have to adjust that for the effect of inflation.
And your required return.
Sure.
Well. So if you only adjust it for inflation, that's all you're going to receive from your investment.
Yeah, okay. So just to keep things simple, if it's valid, for the sake of the example, say without adjusting it, the cumulative owner earnings over the next decade is going to be $30. But because you know that inflation will happen, you have to adjust that, and say the result of the adjustment is that the cumulative owner earnings over the next decade today is worth $10. Am I correct so far in this being how the concept works?
Yeah. So okay. The price you pay.
Yeah. So I'll keep going then. So then, because we make errors as active investors, we just make mistakes. And also because sometimes these businesses don't disclose enough to the stock market through their annual reports, etc., there's a potential for error. So like good financial engineers, we have to factor in to our approach the potential for error. So we use what's called a margin of safety. And your one, as far as I can recall from the ebook, is 20%.
Yep, minimum of 20%.
Right. If my maths is not too far off, that means it becomes safe to purchase it when it's $8.
Yeah, yep.
Okay, but then we can be confident that our money is not going to reduce in real terms over the next decade if we purchase it for that sum of future free cash flows for $8. We will come out.
Well, I mean, there's a lot of variables that
definitely
go into play,
but in a perfect world, we'll come out even if we purchase it at $8.
Exactly, yeah.
After
you not even, because if it's a perfect world and you've purchased it at a 20% discount to the intrinsic value, you're going to come out with a return above your discounted rate.
Okay. All right,
cheaper.
but we can't bank on that, because the reason we have that margin of safety, I'm sorry, did I understand you correctly? So
yeah.
But we can't bank on there not being an error. We have to bank on there being an error. So we have to bank on that we must. I'm not getting it, but
maybe the margin of safety can be seen like a tip, So if you've done a good job, in your analysis, and you've paid a 20% margin of safety, then you're going to get that full 20% tip. But if your analysis hasn't been very good and hasn't turned out to play, your tip's going to keep reducing to be smaller and smaller.
Sure. But regardless, so what I was building up to was that the job of the investor is not to hunt. You haven't done your job if you buy it for $8. What you're looking for is to buy it for $6. Anticipating that it will increase to a value of $8. No.
Well, anticipating it would increase to a value of $10, but I mean, for me, if I get the opportunity to buy a good quality business at a fair value or a discount to its intrinsic value, I'm not going to sell it once it reaches intrinsic value. I'll just keep holding on to it.
You're hoping it will go above that, but
above it and fall back.
Fair value. So fair value. Sorry to butt in. So is fair value $8, because that includes the margin of safety?
Well, for my own myself, then yeah, I'd say that's sort of like a fair value to buy it at.
Ben's shaking his head.
Fair value of the company is the discounted cash flow that equals the return that you're going to put into it. Whereas the price that you're going to pay, the margin of safety is just a risk mitigation.
Yes.
So the value of the business is the fair value, I guess. Yeah, and that's correct.
But what your job, Alistair, is that you're running around, you're discounting the cumulative $30, you're adjusting that to present value, you're doing that, and you're finding that it's $10 that it's worth, that future free cash flow is worth, those future earnings are worth only $10. So you're doing that adjustment. Then, because you're humble and smart enough to recognize that you make mistakes, you are then adding a 20% buffer to that. So you're saying, if it's $8, then I can feel safe committing capital to that, because that's how much, it's all else being equal and the growth rate, that's how much this money will be worth expressed as owner earnings over the next 10. But actually, you're looking for opportunities, aren't you? So you're looking for the $6 or the $5, the 50-cent dollars.
If I can get it at that, then that's just an added bonus. If I only have the choice between two investments, quality would come before price, provided it is below its intrinsic value plus the margin of safety. I would probably be more inclined to buy the better quality business at a higher price than the lesser quality and lower price, because over time, I believe, or as I've read, that higher quality business is more likely to keep performing well, and then just that compound growth rate, self-fulfilling prophecy, really. Like, whereas if you buy the lesser quality business, it might be cheap now and it might rally up, but then for whatever reason it falls back down again, or your first priority should be quality, and then second priority is price, but provided that it's below intrinsic value.
And intrinsic value is simply adjusting the $30 down to $10. That's your intrinsic value.
Yep. Well, the intrinsic value is the actual value of the business. Yeah. So you got market price and then the intrinsic value. And most of the time, a lot of the time, it's pretty close to the market price, and intrinsic value are pretty close. I've actually just started an additional chart, which you can see on my website as well, which tracks my portfolio, the market value versus my intrinsic value as well. So it'd be interesting to see how that plans out over the following years. You'd expect that the market value will go up and down quite a bit in comparison to the intrinsic value of the portfolio. So, and just in the last few months, that market value has gone up above the intrinsic value of the portfolio. So that sort of indicates to me that overall my investments are trading above their intrinsic value, if that makes sense. If that market price falls below the intrinsic value, then I sort of know that overall my portfolio, so the risk is trading below the intrinsic value. So probably means that there's opportunity to increase my holdings.
All right.
These things just don't come intuitively to me. I'm determined to be honest about it until I get it.
Yeah.
It's always hard to explain these things as well if it's not in front of you, or something like that. Just to explain in words concepts like discounting.
The reason I'm trying to be so honest about it is I think a lot of people just don't get it either.
Maybe a better term should be developed, and I think people would understand it better rather than discounting, because the layman thinks of discounting as you're getting some sort of value, you reduce the price of something, and it is associated with that. But a better term would be something like the value to the investor of future cash flows. The true value, maybe not objectively, subject value of future cash flows.
Roger Montgomery calls it the investor's required return, which makes it more self-explanatory. It's your required return as an investor, is that discount rate. So that's what you discount the future cash flows by. Because if you don't have a discount rate and you buy a business for $10 and the next year it pays you, it's in business for 1 year and it pays you a $10 cash flow, you haven't earned anything on that. So if you discount that cash flow by 10% and you buy the business for $9 and then next year you receive that $10, you've made 10%. But if you discount that cash flow by 20% and you pay $8 and then you receive the $10, then there you go, you've received 20%. And you just keep doing that for every future year. So in 2 years' time, if you discount that same $10 cash flow, instead of the business only being in business for 1 year, it's going to be in business for 2 years. So you've discounted the first year's cash flow $10 by 10%, so that's $9. And then the second year's cash flow, you're going to receive another 10%. So you discount that by 10% over 2 years, and that's what, $8.30 or something like that. I don't know. So then there's $17.30 you pay for those two $10 cash flows, and then that equates to 10% return on your money over 2 years.
Rather than discounting future cash flows, is just project out your future cash flows, don't discount them, but you actually put your investment and escalate your investment by your required return. So if it's 10% or 15%, then you just grow that, and then you compare the business's future each year cash flows, net cash flows, to the growth in the investment that you make and see if they're exceeded or not.
Yeah, that would work. Yep. So you grow your $10 investment by 10% a year, and you compare that to the cash flows, which are going to grow, the $10 cash flow, which is also going to grow at whatever it is. And if they come out the same, then that's, yeah.
So the growth in the owner earnings or the free cash flow of the business should match the growth rate that you want to achieve, your required return as an investor.
At least, yeah. Ideally better. But so if you put in $100 and you say you want 10%, then in year one you get $110 from your desired investment. And then you compare that $110 to the year one net cash flow of that business and see whether, if the net cash flow from the business is $110 or $111 or $112, then you buy it, theory.
That makes things so much easier. It seems more intuitive than discount cash flow. I'm not dissing this very credible approach, but I'm just being honest about the difficulty I have grasping it intuitively.
In year two, you would say your $110 should be worth $121 because you've done 10% on top of that again. So compound. So you compare the $121 to the year two net cash flow of the business. And that way you avoid the whole discounting confusion, but that's all you're doing. Like when you but in a reverse.
Yeah, that Makes sense.
Yeah, I think it's very easy to calculate and understand the compound annual growth rate of owner earnings. That's easy to calculate.
We've got fun questions now. Fun questions. Can you explain discounting in Spanish or something? No. So this one's a behavioural question, and it's, we all learn how to wash our hands in the coronavirus world. Hopefully most of us learned to do it in primary school as well. So we've learned about hygiene. What about mental hygiene? What should we start doing from a mental hygiene equivalent of washing our hands?
I think that a big problem is the access to liquid investments, really. When you buy your home, because it's an illiquid market, you don't panic whenever there's an economic crisis around you, because you're not intending on selling that house because you live in it. It's your house. So if you take that same philosophy into your investment philosophy, you're buying these businesses as a business. It's you owning this business. And if you think to yourself that I've got to hold this for so many years, you can remove a lot of those temptations to sell. But I think that's a big thing, is just having that long-term mindset would remove a lot of the issues around the stock market.
Peter Thornhill, go Ben.
I said like 3 generations of wealth holding.
Exactly. If you look at my portfolio, I've got furniture, which is going to be around for a long time, and jewelry. Humans have had jewelry from the Stone Age. It's always been a part of our culture and lives. Travel, we've been expanding and circumnavigating this globe for, since we could walk. And then also the next biggest holdings are a funeral home. And I'm assuming we're going to keep dying for a little while yet. So having that long-term mindset and just you don't have to worry about and investing in industries which have been around for 100 years or 1,000 years and going to continue to be around, it helps, gives you the confidence to
Did you
hold
say
on.
investing in funeral homes?
Yeah, one of my investments is in Vocare, which owns funeral homes.
What did the stock price do over the coronavirus period?
So originally it spiked up because everyone thought, oh, that's good, everyone's going to die from the coronavirus. And then they realized, oh, hang on, we've all been put into lockdown and we're not allowed to have funerals anymore. So all these funeral homes aren't going to be able to receive a full service funeral, so that the cash flows are going to be reduced. And then also there's been in Australia about a 3% decline in the death rate, and then New Zealand's about 5% because of isolation and things like that. We've seen a reduction in the death rate.
What's caused the reduction in the death rate? Sorry, is that
because of increased hygiene? Usually the flu kills a lot of people and things like that, but now we're all social distancing and everything because of the coronavirus has seen a big reduction in those types of deaths, really.
Jeez, okay, wow, interesting, very interesting.
Okay, so human sacrifice is no longer common. It used to be a part of many cultures around the world, but was banned, for example, in Rome in 97 BC. What is something we routinely do now, which we looked upon in 2,000 years as highness? Speaking of discount cash flow analysis.
Yeah.
And just to add to that, with your investment in funeral homes, are you hoping to bring back human sacrifices?
Well, I plan to be frozen, so I'm probably not a good person to be buying a funeral home business. But I guess I think the way we treat and use animals, without sounding like I'm preaching or anything, but I think it's going to be something which we might look back on and think perhaps could have done that better. And yeah.
Give us some more detail on that, Alistair.
Well, just the animal industry as a whole, I guess, there's a lot depending on your beliefs, I guess, the research you choose to look at, but there's a lot of, on it from a climate perspective, it causes a lot of carbon emissions. So it's increased climate change, all those issues. And then animal ethical perspective, it's the farming practices could see a lot of improvement.
I think the word highness is a good one to use for the farming industry, the dairy industry, how little chickens are dealt with in their miserable lives in these factories.
Well, yeah. I mean, you think about it. We've got pet dogs and cats and things, so we've got an affection towards them. And we look at places like Vietnam and eat dogs, and we think, oh, that's just outrageous. How could they eat a dog? But it's only because we have that affiliation towards dogs and appreciate their intelligence and their affection. But I mean, I recently just found a rabbit at Christmas time, which was in our neighborhood, and we couldn't find its owner. Even just having this few months having this rabbit, you sort of appreciate they're actually pretty intelligent and affectionate animals. So now every time I sort of see a dead rabbit on the road, I have a lot more appreciation for its life, just having been taking care of a rabbit for the last few months, and jumps on your lap and gives you little licks and stuff. And yeah, I think there's probably a lot of room for improvement in the way we abuse and use animals.
It will be interesting to see
our
over
own benefit.
2,000 years, how our attitude evolves to do with animals.
And from a health perspective as well, think of all the money which is being spent on in the health industry, and heart disease and diabetes and arthritis and all those things, and a lot of cancers and stuff. Plenty of evidence to link the food we eat to our health. I guess we might look back and say maybe we're a bit stupid to have such a large proportion of our diets consistent from animal products.
There are a lot more militant ways to make that point, Alistair. So that's a nice note to finish on. So Alistair, I still haven't gotten enough about your comments on discount cash flows. Where can I and others go for more material from you online about how to really get to the bottom of discount cash flow analysis?
Growthwithvalue.com. Yeah.
Great. And you've got a Slack group as well.
Yeah. So if you want, just send me a message and I can join you up to that. And I'm just probably more, because I don't like to send out emails and clog up people's inboxes. So I figured I offered people a place to join on the Slack group, but just the nature of my investment style, it could be years before I have anything which is worth investing in. Because on there I share any updates to my website and any podcasts, or even my buy and sell trade orders and things, but don't expect it to be overly active.
Great. Okay, so it's growthwithvalue.com, and basically everything is available from there. There is a newsletter that you can sign up for.
Yeah, you can sign up for them. So if you want to download the ebooks and the spreadsheet, at this stage I'm going to be sending a quarterly update around my portfolio and then anything of interest. I also have book summaries as well. I've just started doing. You might find them helpful. So you can just download them as well from the website.
Okay, so if users basically browse your website and see all the outputs that you've made, they can see basically what it takes, which is the point of this episode, to get to that higher geometric return of 25% as an active investor, as opposed to sitting back as a passive investor. There's a lot of extra effort to put in. And if you look at Alistair's website, there's a clear expression there of the level of work it involves. I've got one more question. So you mentioned earlier on that there's a screener that you use based on Kenneth Marshall's Good Stocks Cheap book. Do you have that screener on your website, or where do you do
that's in my spreadsheet. So once I've inputted all the financial data, I think I shared it with you at one point. It just each year of historical data through each of Kenneth Marshall's criteria, it'll highlight between green and red on a varying basis whether it's a good or...
Okay, but you have to go and find that stock and put it in your sheet, right?
Yeah, I'll go through it in one of my podcast episodes.
Right. Okay.
About the screening process. But I mean, that's a very short, easy part of the whole overall process. And then I also have a watch list on my website as well, all the stocks which have passed through my screener and ethical screen. So you can just access that.
So we'll put as show notes the links to the Growth with Value podcast and your website, and also specifically the screening episode, because that sounds useful as a way to rip out 80% all the noise from the market.
I also have a discounted cash flow episode.
Thanks, Alistair. All right, I'll go and listen to it now.
Yeah, you can help you go to sleep.
Perfect.